Okay, we'll go ahead and get started with the final session for today. We're scheduled for 75 minutes, and we will do our best to keep to that and get you out on time. We do have a number of polling questions during this session, so just please be aware of that. So this is going to be a discussion of PCAOB inspections overview and illustrative examples related to the broker-dealer inspection program. I'm Greg McCune. I'm an associate director, work out of the Boston area, and spend most of my time working on inspections of firms that audit fewer than 100 broker-dealers. That's most of your middle market and smaller firms. To my left immediately is Violet Wojcik. Violet is a senior inspector out of our Chicago office. And Mike, to Violet's left is Mike Walters. Mike is an associate director out of our Charlotte office. So that we'll go ahead and get started. So as with all the presentations today, the views we express are in our official capacity as members of the Division of Registration and Inspections, but are our own and do not necessarily reflect the views of the board, board members, or other members of the staff. So the first CPE code for this session is 413. Okay. The objectives for today's session is at the end of the session, you should be able to identify relevant PCAOB publications for auditors of broker-dealers, discuss some of the observations from our 2022 inspections, understand the requirements of PCAOB standards, including some examples of deficiencies and good practices for selected areas, understand insights regarding recent inspection results, and understand the status of our 2023 and 2024 inspection activities. So I'm going to just take a few minutes and go over some publications that are available to auditors of broker-dealers, available to everybody actually, but of specific interest to auditors of broker-dealers. First is our annual progress report on the interim inspection program. We issue that report generally every August, and the report for August 2023 provided the results of our inspections conducted during calendar year 2022. We're in the process now of gathering the information and results from our calendar year 2023 inspections and expect to reissue that report sometime later this summer. In addition to that report, we've been providing the past couple of years a supplementary document that provides additional information regarding additional data related to the statistics that underlie the inspection results in the report. In addition, in January, this past January, we issued our first spotlight, which focused on the interim inspection program. It provided insights from our inspections that might help explain the level of deficiencies that we've been seeing, and we'll cover some of those insights in our discussion today. In addition, an oldie but a goodie is the staff guidance for auditors of SEC registered brokers and dealers. We issued that back in June 2014. That was more or less coincident with the adoption of the amendments to Exchange Act Rule 17A5, which essentially was when the notion of the compliance report and the exemption report were introduced. The information in that document, though it was issued almost 10 years ago, is still very much relevant today. In addition, there are a number of other publications that are available on the PCAOB website, not specific to broker-dealers, but the information in there would be very relevant to auditors of issuers and broker-dealers. First item is there's a spotlight on root cause analysis, which focuses on root cause as an important procedure that many audit firms use to evaluate the adequacy of and compliance with their quality control system. Second is a data and report spotlight, which was aimed at improving auditor understanding of how to properly test information produced by the company and information from internal sources. Thirdly, we published a priority spotlight, which is a preview of the upcoming inspection season. It covers all inspection programs, including the broker-dealer program. And then lastly there's PCAOB staff guidance that may be helpful in evaluating relevance and reliability of audit evidence obtained from external sources, which was issued in October of 2021. This guidance discusses the increasing use of information from external sources that auditors plan to use as audit evidence in the considerations regarding its relevance and reliabilities. Firms may find this guidance helpful in performing audit procedures for revenue and other areas of the audit. So quickly, I'm going to go over our 2022 inspection results. As I said earlier, we're still collecting the information from our 2023 results, and those will be included in our next report, so it'd be premature to discuss those results at this point. But I think if we could talk about the 2022 results, they will be informative for our purposes. So overall, we were surprised by the results of our most recent inspections. Specifically, we saw that there was an increase in the number of findings, the percentage of findings across almost all areas. There was some improvement in the percentage of examination engagements with deficiencies. Went down from 64% in 2021 to 50% in 2022, but in all other areas there was an increase, a fairly marked increase. And this trend is prevalent throughout the PCAOB. It's not restricted to the broker-dealer program. And as Chair Williams mentioned in her recent article in the Wall Street Journal, these findings are unacceptable, but ultimately the responsibility for correcting these deficiencies falls on the audit firms. The key drivers of the high rate of deficiencies by engagement type for broker-dealers include we've seen persistently high rates of deficiencies related to revenue. We've seen increased deficiencies related to net capital, the supplemental schedule. In addition, we've seen increases in the rate of deficiencies related to the auditor's report and auditor documentation. With regard to review engagements, specifically AT2, engagements under AT2, we've seen an increase in deficiencies related to the auditor's consideration of evidence that appeared to contradict statements or assertions included in the broker-dealer's exemption report. For example, broker-dealer might claim K2II, but there's no evidence that the broker-dealer has a clearing arrangement or introduces customer trades to a clearing broker. And then the last item here was we've also seen an increase in review engagement, deficiencies in review engagements related to the form and content of the review report, the auditor's review report. What's particularly been troubling is we've seen instances where the assertions included in the auditor's report are not at all aligned with the assertions or statements made by the broker-dealer in its exemption report. So in response to these deficiencies, that's what caused us to take action to issue the spotlight that we issued back in January. And we're hopeful that firms have been able to take a look at that document and incorporate some of the concepts in there as they prepare for their future engagements. So I think we have our next CPE code coming up, which is 107. While everybody's writing that down, I'm going to go ahead and turn this over to Violet, who's going to walk through some of the deficiencies we've seen in revenue over the past couple of years.
Thank you, Greg. Okay, so the first area is auditing revenue, which continues to be a challenging area for firms on the financial statement side. In 2022, audit engagements show, as Greg pointed out, persistently high deficiencies related to revenue, and many of these deficiencies were identified at mid-size and smaller auditing firms. Most of these deficiencies related to firms that did not adequately respond to the risks of material misstatement for each relevant assertion for each significant revenue account that was identified, including disclosures. So firms should really continuously challenge that their audit procedures performed over revenue sufficiently address each relevant assertion. Since 2018, we have included good practices or recommended actions related to auditing revenues in our annual report, which I think would be a great resource for firms to identify areas where revenue procedures can be improved. And then in 2022, we identified deficiencies in auditing several common sources of broker-dealer revenue, and I'll run through some examples. So the first one is for commissions. Firms did not sufficiently test whether the commission that was recorded was actually accurate and was based on the terms of security trades, which would include the price and the quantity, as well as the commission rate. With respect to investment advisory fees, we noted that firms did not sufficiently test the accuracy of assets under management and whether the fees were consistent with the terms of the arrangements that they had with customers. For trading gains and losses, firms did not test the prices and quantities that were associated with securities purchases and sales. For investment banking fees, firms did not sufficiently test the amount of capital that was raised, the rate that was used to determine the fees, whether the investment banking transaction actually occurred, and whether the performance obligation was satisfied prior to recognizing that revenue. Okay. And then for mergers and acquisitions and other advisory fees, firms did not sufficiently test whether the merger and acquisition transaction actually occurred or whether the advisory services have been performed. We continue to find deficiencies in auditing revenue at larger firms as well, though it's not as frequent as with other firms. Nature of the issues varied from other firms as well, which included unsupported risk assessments that would result in insufficient substantive testing procedures. Teams used information produced by broker-dealers in performing their substantive procedures, but did not test the accuracy and completeness of that information. Misapplication of AS 2315, which is the audit sampling standard. For example, firms did not make selections from a complete population or in a way that selections were representative of the population that was being tested, and then not evaluating whether revenue streams should have been disaggregated in accordance with ASC 606. Okay. The next area is performing review engagements. In 2022, review engagement deficiencies increased in part due to issues related to reporting the review engagements and the auditor's considerations of evidence that appeared to contradict the statements that the broker-dealer made in their exemption reports. Many of these review report deficiencies involved mischaracterization of the assertions that the broker-dealer made in their reports. And these deficiencies probably could have been easily avoided if firms performed the reviews with due professional care. All right, so we would recommend that auditors compare the assertions that the broker-dealers make in their exemption report to references to assertions in the firm's review reports to avoid those inconsistencies. We also recommend that auditors take into considerations the required elements of AT2, specifically paragraph 16. There's also an illustrative example of the review report in paragraph 17 of AT2, as well as the broker-dealer's exemption report requirements in paragraph D4 of SEC Rule 17A5 when you perform these reviews. So when inconsistencies are identified, we would recommend that auditors obtain an understanding of the reason for the inconsistency and whether one or both of the reports would need to be modified. All right. So if a broker-dealer omits the statement that's required by Rule 17A5 from its exemption report, we recommend that auditors encourage those firms to include those required statements. Okay. So next is the consideration of evidence that appear to contradict the statements that the broker-dealers included in their exemption reports. Often we observe that broker-dealers, specifically those that only claim exemption under K2II, also conduct customer securities transactions that are outside of those arrangements with clearing brokers. So for these broker-dealers, we recommend that engagement teams discuss the evidence that was obtained during the audit regarding the nature of the broker-dealer's operations, the services that it performs, and how that relates to the assertions that the broker-dealer made in its exemption report. And one last point is that most of these deficiencies were identified at the mid-sized and smaller audit firms. All right. The third area is performing examination engagements. I'd like to comment that we have seen on inspections, and I'd like to comment on what we have seen on these inspection areas, but also provide you with some examples how these challenges can be addressed. So let's start with testing of internal controls over compliance, which is related to 15C3-3, customer protection rule. And this rule encompasses customer reserve calculation, but also possession or control. So for the reserve requirement rule, firms need to sufficiently test controls over two things. One is the determination of credit balances reported within the customer reserve computation. And two, that the broker-dealer establishment and maintenance of the special reserve bank account for exclusive benefit of customers is in accordance with the reserve requirements rule. Okay. For the possession of control requirements, firms need to sufficiently test controls over identification and resolution of the deficits that require action in the time frame that is specified by the rule. Okay. We identified deficiencies in testing ICOC in other areas as well. So for account statement rules, firms need to sufficiently test controls to ensure that all customers receive their accounts, account statements, either electronically or by mail. They need to make sure that there are controls over customers that consent to receive account statements electronically, and whether those customers actually have access to their account statements. And the third one is controls over completeness and accuracy of the information that's included in those customer account statements. For the quarterly security counts rule, firms need to sufficiently test controls over the verification of securities that were subject to broker-dealer's control or direction, but not in the broker-dealer's physical possession, where such securities were in that status for more than 30 days. We found the fewest issues with testing controls over the net capital rule. That could be because firms are a lot more familiar with this particular rule since it applies to the smaller broker-dealers and the large broker-dealers that are compliance filers. After all, any audit of a broker-dealer any audit of the, oh my gosh, I lost my spot. involves some consideration of the net capital rule, given that there is a supplemental schedule that's included in the financial statements. Okay. Generally, broker-dealers that file compliance reports tend to be the larger broker-dealers that carry customer accounts and that have responsibility for customer assets such as customer funds and securities. And many of these broker-dealers are audited by larger firms, though some are audited by mid-size and smaller audit firms. Most mid-size and smaller firms that audit compliance report filers tend to audit a very small number of them, so they may not be as experienced with applying AT1 procedures. Okay.
Okay, thanks, Violet. Get your devices ready. We're about to go through a series of short examples touching on several of the topics that Violet just covered. So we'll see how well we picked up on the concepts as a group. The topics are listed on the screen. And before we do that, we do have our next CPE code, 908. So the next set of slides will present a very short fact pattern followed by a multiple choice polling question. And so focus on I'll recap the facts for you. 908 is the CPE code. And our first topic is, no surprise, revenue again. This one focusing on presentation and disclosure, however. So here are our facts. For our hypothetical broker-dealer, if you looked at the income statement, you would see commissions of $6 million. But what are those commissions comprised of? There are three components. Each component is $2 million. And those components are commissions from the initial sale of the mutual funds, Mutual Fund 12B1 distribution fees, also $2 million, and then merger and acquisition advisory fees of $2 million. And again, these are reported as commissions if you looked at the broker-dealer's income statement. What disclosure exists? This is the entirety of the disclosure. Commission revenues primarily include commissions from the initial sale of mutual fund products and are recognized at a point in time on the trade date. So keep those facts in mind and then tell me, okay, Brian gave me a heads up on this. Because they can't see the questions either, right? Hopefully you can see the question itself. I'll read it. There's a multiple choice polling question here. So which of the following is true regarding the application of AS 2301 and ASC 606 to that fact pattern? So A, the auditor does not need to evaluate whether there are distinct performance obligations related to the three revenue streams, since they're all reported as commissions. B, the auditor should evaluate whether the payment terms for revenue complied with industry standards. C, the auditor should evaluate whether the three revenue streams should be disaggregated into categories in the broker-dealer's financial statements. And D, the broker-dealer's disclosures appear to satisfy ASC 606 requirements. So perhaps you've had a little bit of time while I was reading those options, and I'll look to, Brian's gonna give me a heads up when we have sufficient responses, and maybe tell me what maybe the top two selected options were, and then we'll debrief.
Very heavily C.
C, that's a good sign. I'm liking C very heavily. No clear-cut second? Nope. Okay, perfect. Great job, because the correct answer is C. The auditor should evaluate whether commissions related to each of the three revenue streams should be disaggregated and separately disclosed. There's good guidance in ASC 606. I won't read all of the guidance to you, but it establishes that disaggregation is an important concept when it comes to the presentation of revenue. And then, the overarching requirement is to disaggregate along categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. It's pretty broad, that's pretty principles-based, I would agree, but in a later paragraph, there are additional considerations for companies to consider in applying that guidance. And I won't read all of them, but a couple that I think may have some particular relevance to a broker-dealer would be other factors to consider when deciding disaggregation include disclosures presented outside of the financial statements, and also information that the company itself or other users of the financial statements may receive and use in the evaluation of the broker-dealer's performance. So, cutting to the chase here, I think that who are commonly accepted as other primary users of broker-dealer financial statements. That would include regulators, typically the SEC and FINRA, maybe other regulators. And what is an important regulatory reporting requirement, that would be the focus report. And so kind of connecting some dots here, we think it's reasonable for broker-dealers, but also auditors to consider how presentation in the focus report, as called for by the focus report, should be considered when disaggregating revenue for purposes of the financial statements. And those three revenue categories that were covered in the facts, if you looked at, it's part 2A of the focus report, but also the supplemental schedule of income, form SSOI. If you looked at those two in tandem, you would see that each of those revenues types are called for to be separately reported to FINRA in the focus report. So we think that's a reasonable consideration for auditors and, again, broker-dealers to make when considering this question. The economic factor itself, certainly more judgmental there. In certain cases, reasonable people may reach different conclusions. I think that's fair. But looking at this particular straightforward fact pattern, merger and acquisition advisory services, how broad economic factors might affect that business, comparing that to the sale or ongoing maintenance of mutual fund positions by broker-dealer customers. I mean, those are just fundamentally different products, different services. I think it's reasonable to conclude that economic factors are going to affect those quite differently. So that's how, at least I would see the application of that principle to this fact pattern. Maybe a little more nuanced if you're drilling down to commissions on the initial sale of a mutual fund versus an ongoing stream of 12b1 fees. But again, those are the principles, and it applies to any revenues that are derived from contracts with customers, right? That's the scope of ASC 606. That's the thought process that broker-dealers should be going through, and then auditors should be challenging that during the performance of their audit. But the team did a great job. Obviously, we had a high rate of accurate responses there. Okay, here's our second scenario, journal entry testing. Okay, so in this instance, the auditor identified management override of controls. It's a fraud risk, okay? So auditors going through obtaining understanding of the broker-dealer's financial reporting process and learns that, hey, journal entries are not required to have descriptions, okay? The auditor concluded that represented the risk of incomplete journal entry descriptions, potentially represented a fraud risk, alongside other identified fraud risks in the journal entry population. So this team's gone through and identified multiple fraud risk factors in the journal entry population. The auditor did perform procedures to test completeness of the population of journal entries, and did note that there were entries both with descriptions and without descriptions. So I'll go ahead and open up the poll as I read. So again, we're looking for the factor or the statement that would be true with those limited sets of facts. Okay. A, because journal entries are not required to have descriptions, the auditor would not be able to evaluate whether the journal entries are accurate. Okay. B, the auditor should only select journal entries without descriptions to test. Okay. C, as part of its fraud inquiries, the auditor should inquire of individuals involved in the broker-dealer's financial reporting process regarding any requests received to exclude descriptions from journal entries or to include inaccurate descriptions. And then D, if there's a large population of journal entries without descriptions, the auditor can select a sample of those entries to avoid testing the entire population. So a little bit, you've had a few seconds to think about that. I'll wait for my cue from Brian. We'll see how we did on the fraud case. I think this one might be a little bit harder than the previous one, but we'll see. What do we think?
So 80% C, 50 was a distance sector.
All right, 80% C, the 80% is correct. Tailored fraud inquiries, required to do fraud inquiries, there's an opportunity to tailor those inquiries specific to the fraud risk identified. So I do think that would be a good procedure for the auditor to consider. And D, I can understand D as a little bit of a trick answer there, but let me speak to it for those 20% or so that said D. D again was if there's a large population of entries without descriptions, the auditor can select a sample of those entries to avoid testing the entire population. The point we're trying to make there was also one that our NAF counterparts made earlier this morning when they were commenting on the same subject, and that is auditors need an appropriate rationale for sampling once entries with fraud characteristics have been identified in the population. I don't think a good rationale would be, I want to test fewer entries. So yes, it doesn't mean sampling is not a valid approach in this area, but you need to have a good rationale supporting your decision to test a sample of entries. So a little bit of a trick one there, I will admit. Okay, let's move to our third case here. Call them cases, they're very, very short cases. We're now jumping into compliance report filers, which I recognize not everyone may have necessarily have experience with those. And so this is AT1, testing internal control over compliance. And this example is specific to the account statement rule, which was one of the topics that Violet mentioned earlier. Okay, so what are our facts? A broker-dealer provides all customers who consent to electronic delivery access to their account statements in electronic form. I don't think I said that right. Okay. Hey, if you consent to electronic delivery, the broker-dealer delivers your statement to you electronically. That's what that's saying. Okay. The broker-dealer generates the statements using information from its internal systems and maintains the applications where the account statements are stored, maintains the portal through which customers access those statements. In other words, there aren't third parties involved here. There's not a vendor producing the statements. There's not a service organization behind that. This is self-contained within the broker-dealer in this example. Okay, and the auditor determines controls over electronic delivery of statements to be important. It's important to the broker-dealer's ICOC conclusion, which would suggest under AT1, those are controls that should be tested. So a little bit of a hint there. And let's advance to, I messed that up. I might have clicked twice. Let's try again. Okay, one click. Leave there? Okay, all right. So the possible, okay, so which of the following would be true given those, given those, is this mine? Okay, yeah, this is it. These are the answers. Okay. All right, so which of the following is true regarding the auditor's responsibility here regarding testing controls? All right, here we have A, the auditor understands that the broker-dealer's process is to make account statements available to customers via a portal. So the auditor doesn't need to test controls over completeness of the population of customers who are supposed to receive account statements. Okay. B, if the broker-dealer makes account statements available to customers on the portal, regardless of customer consent, the auditor doesn't need to test controls over customer consent to electronic delivery. C, the auditor only needs to test controls over completeness and accuracy of the information on the customer account statements. Finally, D, the auditor should test controls over customer ability to access their account statements via the portal. So we're looking for the correct answer here. And am I able to open it, Brian? Are they able to respond? Okay. They can? Okay, all right. Great, so. Okay, we got, once again, the 80% carries the day. 80% is correct. The auditor should test controls over customer ability to access their account statements via the portal. The concept of delivery is, it's not expounded upon in the if you go read the account statement rule, but I think it's a basic notion, a basic consideration that delivery encompasses the recipient's ability to see and use that information. So if you apply that to a context where it's a digital delivery of a statement, the customers need to be able to see that information. So that's what's being reinforced through D. Now, C, had the magic word only in there. That should have been the clue for those of you who said C, that you only need to do that. Typically, you don't only need to do one thing, but you do need to test controls over the completeness and accuracy of the information in the statements. But that in and of itself wouldn't encompass key questions like successful delivery. Also, hey, do we have control over the population of customers who need to receive statements, who are entitled to receive statements, whether monthly or quarterly under the account statement rule? Okay, so again, good job there. We have one to go. Let's move to, okay, can I advance? All right. Okay, AT2. So now we're back to exemption reporting here, perhaps a little more familiar to the group as a whole. This is about reporting, not so much the review procedure. So let's focus on reporting for a moment. A broker-dealer files an exemption report that includes the following statements. Some of this touches on what Ann covered a little while ago. Hey, this broker-dealer is relying on footnote 74, okay? That's why it's filing an exemption report. It says so in its exemption report. It limits its business activities exclusively to underwriting and merger and acquisition activity. The third statement is basically throughout the year, I didn't directly or indirectly receive customer securities, customer cash. I don't owe customers any securities or cash at no point during the year. I don't carry customer accounts. I didn't carry PAB accounts. All those statements exist in the broker-dealer's exemption report. So now we think about the auditor's review report and which of the following statements would be inappropriate for the auditor to include in its review report. Again, I gave you everything that the exemption report said. A, there's some lead-in language. Hey, we've reviewed management statements included in this exemption report in which the broker-dealer stated that A, its business activities were exclusively limited to underwritings and M&A activity. B, it did not directly or indirectly receive, hold, or otherwise owe funds or securities to customers. Didn't carry customer accounts, didn't carry PAB accounts. C, it met the identified exemption provision without exception. Or D, hey, all three of those statements would be appropriate. I don't see anything wrong with the review report as kind of drafted here in this example. Okay, so we'll give that a little bit here, and Brian will tell us. I predict we're going 4 for 4, but let's see. Let's see. Oh, Brian's not as confident. Good, that means I had a good case for once. Let's see. Maybe that means there's more of a differentiation among the responses. How's it look? 60%? 60% D, okay, 25% C. Actually, the 25% is right in this instance. So this whole question hinges on the statement in C. What was the statement in C? The statement was it met the identified exemption provision without exception. Now, testing your memory a little bit here because I haven't, have the facts again in front of you. But on the slide that conveyed the facts, there was no commentary whatsoever about the presence or absence or count of any exceptions whatsoever. Why might that be? Well, it could be because for this broker-dealer claiming footnote 74, technically that's not an identified exemption provision at all. The term identified exemption provision generally refers to a claim under paragraph K, K2I, K2II, K1. Those are identified exemption provisions. Now, this broker-dealer is making a claim that it should file an exemption report for an entirely different reason, that it qualifies under footnote 74. So maybe that's why the broker-dealer didn't make that statement. But either way, the why, setting aside the why, the overarching point here is auditors shouldn't ascribe statements to management that management didn't make, period. Pick any approach that the broker-dealer took for explaining why it's filing an exemption report. The auditor's review report should be tailored to reflect, to opine on the actual statements being made, not other statements that are not being made. And to our surprise, we do see this with some frequency. And it's not really meant to be a trick, not meant to be complicated per se. Start with the statements management is making. Those are the ones that you're addressing. I shouldn't say it's not an opinion. I shouldn't say opine on, but that your report addresses are the statements that management is making. So that's really the key point there is you're going to encounter a variety of exemption reports, particularly for these footnote 74 broker-dealers. They're going to say things a different way. That forms your starting point for your review report and, by extension, your review procedures. So keep that in mind. And the other thing, just while we are on AT2, on inspections, we're always thinking about, hey, I see what the broker-dealer says about its business. Does it appear that those statements actually address all of the customer securities businesses that the broker-dealer conducted during the year? We'll look at the financial statements, other information we have available to say, this has actually seemed complete, what the BD is saying in its exemption report or not. And if not, if this were an inspection, you could expect questions along those lines from as the auditor. So those are two kind of
Mike,
important. Yeah, Greg, please.
I think the takeaway there is if you think your client's exemption report is deficient because it doesn't include a assertion that it should include, or it doesn't reference a line of business that should be referenced, that's a discussion to have with your client and try to compel them to update the report accordingly. You shouldn't be making the corrections in your review report. That's not your responsibility, nor is it appropriate, because again, you're only supposed to be reporting on the assertions the broker-dealer makes.
Yeah, I'm hard-pressed to come up with a reason why a broker-dealer would intentionally omit a securities business from its exemption report. I think this has been an evolving area. I think broker-dealers are trying to do the right thing, trying to cite guidance that's been made available by FINRA and the SEC on the subject. But auditors can give good feedback on this too, and can bring a critical eye to how the BDs are describing their basis for claiming an exemption, and that's the overarching point there. Okay. We're going to transition. The majority of our remaining time, we're going to focus on a document that was referenced earlier, which was our program's first ever spotlight. And we issue an annual report every year. This year's report not yet available, but in January we issued a spotlight, which doesn't talk directly about the deficiencies, but it takes into account a lot of data that we've accumulated over many years in this interim program, in our own individual experiences on inspection, and seeks to identify, and I will emphasize the word potential, I think that's fair, call them potential factors, potential drivers, potential root causes of the level of deficiencies that we see within audits in this industry. And again, it's and there are a number of them. We're going to kind of, as a team, going to run through each of them that are at a high level that are covered in the document. I encourage you to look at the document if you haven't already. And so it's kind of a different take, trying to pull back the curtain a little bit and think about what could be some of the factors that again have the deficiencies at the level that they are. But sort of to start that dialogue. We actually have, and hopefully you can see, an opinion polling, no right or wrong here, an opinion polling question to just kind of gauge the audience's view on this. Which of the following factors do you believe contributes most significantly to the broker-dealer audit quality challenges? I won't read the list to you. We're going to talk about these items in the next few slides. I'll highlight the last answer, though. That's That was added in there for completeness sake. Let's say, hey, I don't believe there are broker-dealer audit quality challenges. So we certainly encourage you to be candid with your response. So take another minute or a few seconds here to respond. And this time, Brian, maybe if you're able to capture the notes, give me this one's going to be a little more distributed, I think. So maybe give me a top 2 or 3 and see how the audience feels. If the last one is 99%, then I don't know what to do with that. But, well, how are we looking? I'm making Brian work pretty hard on this one. Let's see, we're doing okay. I started this 2 minutes late for the record. Do we have any questions? Not yet. All right.
So, low cost.
Mm-hmm.
Was number one.
Number 1.
Understanding, or sorry, number two is the first one.
Number 2 is the first one, which is understanding of the industry itself. Okay.
Can't be found right.
That's all right. I can't either.
And then the third one was inexperience with PCAOB standards.
Okay, inexperience with PCAOB standards. All right, so we got some distribution of results there. Low-cost providers, challenges associated with auditor changes. 1, insufficient understanding of the industry. 2, inexperience with PCAOB standards. 3, that's good because I think that touches, we each have one of those topics to cover. So why don't we jump into one of those, which is insufficient understanding of the broker-dealer industry. And okay. So again, these are potential causes. What might cause, what experiences might cause the PCAOB to make such a statement? It's a very difficult thing to sort of prove, but there are occurrences on inspections that kind of give rise to this sort of belief that we have. What are some examples? Well, and in particular, with the first bullet, talking about the financial responsibility rules. Hopefully, that term I'm referring to net capital, customer protection rule. If you're a compliance report filer, then the account statement rule and the quarterly security accounts rule. So those are the financial responsibility rules. Well, what challenges are there with understanding those rules? Well, there are times where when we look at audit work papers, there's an absence of citation or reference to the rule in places where it would appear like so obvious that would be the thing you would do to support your conclusion in a given area. And we don't see that, and then teams can't speak to the basis for their conclusion over a regulatory topic. That would give rise to a concern like this, or an inability to, like I said, to respond to a question along those lines about the application of a rule to a given circumstance at a broker-dealer. An interesting one is, from time to time, doesn't happen a lot, broker-dealers will, or auditors will tell us that, hey, a broker-dealer has asserted that this FRR, financial responsibility rule, it doesn't apply to me. Okay, what is the reason for that? And auditor, have you challenged the reasons for that? Do you understand? Can you explain it to us as inspectors? Because on the surface, we don't understand it. And there are times where either the work papers or through interviews, we can't get a good, clear understanding of why something wouldn't apply that would appear to otherwise apply. And then finally, the nuances, the differences between the exemptions available under paragraph K, they are not the same. Some are more restricted than others. Some involve, one involves a special account, so on and so forth. There are nuances there, and there are times through discussions with firms that it seems clear to us that there's not an appreciation for those differences on the part of the auditor. So that's a big one. Revenue recognition policies, I'll just try to be brief and say that this is a key part of most inspections. It's a key part of an audit. You've heard multiple speakers kind of touch on RevRec today. There's a lot of information to help auditors get a handle on this area beyond the financial statements. Depending on the broker-dealer, maybe the broker-dealer has good systems documentation, narratives, or flowcharts to support your understanding. Maybe they don't, but they might. You have the footnotes. Written supervisory procedures can be very helpful in this area. Now, granted, written supervisory procedures, a lot of the content will go far beyond what you might need to understand for an audit, but there can be financial reporting related information in WSPs. And in particular, WSPs often talk about the customer-facing side of the business, how customer funds and securities are handled. That can be important, certainly important in the AT2 area, but can help you in understanding revenue as well. So just an encouragement to really try to refine in future audits, refine your understanding for those key revenue streams. Auditing information related to information from clearing brokers. Not uncommon. There are many auditors whose strategies depend upon or use in the performance of substantive procedures information that comes from a clearing broker. So anytime, I'll speak as an inspector, if we see information being used in the performance of a substantive procedure, our first question is, well, is there evidence about the reliability of that information? And that could apply to internally generated information as well, but this one's about clearing brokers. So, that's not entirely unique to broker-dealers. It's just more common in this industry, and it is our experience that some firms don't really actively consider that, almost take for granted, hey, it's from a clearing broker, right? It's Pershing, hey, it's good. It's good. It's reliable for purposes of my audit. Not necessarily the case. So that's another area of an industry aspect that we think knowledge can be improved. How can you get up the learning curve there? Of course, training. Kudos to those of you participating today. There are other vendors who provide industry-specific training. We're aware of some in our normal course of our activities, but there are firms that generate their own if they think they have the skills and knowledge in-house. So training plays a role here in addressing this, what we would call potential root cause. Here we go. We got another CPE code. I'm going to cover our second factor, and then I need to do that quickly and hand it to Violet. So I'm taking her time. Professional skepticism wasn't one of our top 3 votes, but we never miss an opportunity to reinforce its importance. Obviously, PCAOB standards talk about it. It's an element of due care. It's described and defined within PCAOB standards. AS 1015 talks a lot about professional skepticism. It's a well-studied topic out there in the industry literature. The CAQ found a document from the CAQ that kind of created its own framework for skepticism that we thought was, just for purposes of this training, was interesting and noteworthy. 6 characteristics in the eyes of the CAQ: a questioning mind, suspension of judgment until evidence is obtained, a desire to search for knowledge and corroborate information, an understanding that people's motivation may lead them to provide biased or potentially misleading information, autonomy and independence of mind, and then sufficient self-esteem to challenge assumptions and resist pressure. That last one can definitely be tough depending on the circumstances on an audit. So, I recognize this is an experienced group. Skepticism is not a new concept for us, but it is foundational, it is very important, and we do make observations on inspections that cause us to question the level of skepticism being raised. That could be just simply omitted procedures, not testing a significant account that is clearly material. Obvious errors in an auditor's report, misidentifying the financial statements that are included in the filing, misidentifying the supplemental information that's represented in the filing, obvious gap departures. I remember when the lease standard came out and that the first year was applicable, there were a number of examples where there's clearly material leases here, no application of the new gap. Obvious misclassifications in the statement of cash flows. Things of this nature really start to call into question due care generally, and in certain instances, professional skepticism. So we think this is one of those drivers as well. Okay, Violet, back to you, I think, and to talk about risk assessment. I think I'm on the right slide. Okay.
Sounds good, thank you. Yeah, so next one is lack of rigor in risk assessment and consideration of internal controls. We often observe that engagement teams will assess risk of material misstatement in the financial statements to be low. but they don't necessarily contemplate the required risk assessment procedures at the financial statement level or the assertion level. We have heard that engagement teams will say that, well, SEC and FINRA only use the supplemental information in their oversight, therefore, the basic financial statements are inherently low risk. The other point is that engagement teams will cite that there's high degree of automation and reliance on technology as another factor to support low risk assessment. However, those firms sometimes don't consider the fact that smaller introducing broker-dealers will rely on the information coming from the clearing firms, and therefore, they do rely on the controls and processes of those entities. Other engagement teams also default to a control risk assessment of maximum for all significant accounts, but those engagement teams should also keep in mind that they still need to sufficiently assess the broker-dealer's internal control environment when they are working through the process of identifying and assessing the risk of material misstatement, even if they assess the risk as high. And more specifically, some engagement teams just don't obtain a sufficient understanding of the risks related to the broker-dealer's revenue transaction cycle. So that would be how transactions are initiated, how they are authorized, processed, and recorded, et cetera. Risks of material misstatements can arise from a variety of sources. It could be an external factor, such as conditions in the company's industry and environment. It could be company-specific factors, such as the nature of the company, the activities that they engage in, and internal control over the financial reporting. And then in addition, to identify significant accounts and their relevant assertions, auditors should evaluate the qualitative and quantitative risk factors that are related to financial statement line items and disclosures. As an example, size and composition of the account would be one item. The other one is susceptibility to misstatement due to error or fraud. Nature of the account and disclosure, volume of activity, how complex are the transactions that are processed through those accounts, et cetera. So firms will conclude, for example, that risk of material misstatement based on assessment of inherent risk and control risk at the assertion level be either low, medium, or high, but then what, right? So this is where the concept of nature, timing, and extent of the audit procedures kicks in, as it is further described in AS 2301. Okay. Perfect. Okay. No, it's going. It's good. All right. So next point is over-reliance on standardized audit programs. So in our inspection experience, these audit programs generally provide the user with the text of the PCAOB requirements. They provide some associated references to the standard themselves. However, there can be risks associated with their use. And here are some examples. It may not be all-encompassing. For an example, engagement teams will use the information that's produced by the broker-dealer as evidence. AS 1105 paragraph 10 states that in those circumstances, the auditor should evaluate whether the information is sufficient and appropriate for purposes of the audit by performing procedures to test the accuracy and completeness of the information, et cetera. Or they can test controls over the accuracy and completeness of that information. And so in our inspection experience, this is often a neglected requirement. It may reflect only certain criteria in the standards. So for example, some audit programs will remind the engagement team to select journal entries for testing to address the risk of material misstatement, but they won't include many factors to consider when they determine which entries they would like to test. And it may be limited in scope as far as the procedures to be completed. As an example, the audit procedures in revenue are likely to be written generally such that they can be applied to a wide range of revenue types, but it is necessary to consider the fact that nature and the extent of the procedures may be different for the different types of revenue streams. All right, so these tools can be effective when facilitating engagement planning and performing the procedures, but you need to make sure that they are appropriately tailored to reflect the broker-dealer as they operate. Okay, so a more rigorous risk assessment process that includes a sufficient understanding of broker-dealers' operations, the transaction cycles, related internal controls, they will help the auditors tailor that planned audit procedure more effectively. All right. Firms and engagement teams also need to evaluate how well do the audit programs address the applicable PCAOB auditing standards. I have some examples of standards here that have a significant amount of content, so I'll just list out the numbers here. AS 2110, that helps identify and assess risks and material misstatement. 2301, that's auditors' responses to risks and material misstatement. AS 2701, which is auditing the supplemental information. And then attestation number 2. All right. Okay, next one is ineffective EQR. The degree of noncompliance with PCAOB standards identified on inspections appear to indicate that some EQR reviewers are not sufficiently knowledgeable in GAAP or the industry itself, by not reading the financial statements carefully enough, or they're reluctant to challenge the engagement teams as they review the auditing procedures. So what makes us call into question the effectiveness of the EQR during an inspection? I'll give you some examples. So the first one is errors or inconsistencies in financial statements, and that would include schedules such as supplemental schedules that just don't tie to the financial statements. They don't agree. There could be some internal inconsistencies between the cash flow statement or the balance sheet. There could be omitted revenue recognition disclosures. The next one is errors or inconsistencies in auditor's report, where the basic financial statement could be misidentified. Supplemental information assertions could be mischaracterized in the review report, etc. And then the third point is insufficient audit responses in areas of significant risk. And a lot of times that's basically revenue. So while retaining a qualified EQR from an outside of the audit firm is an appropriate way to address the lack of qualified EQR within the firm, firms can develop EQR capabilities in-house, and as Mike pointed out, it could be through on-the-job training, it could be through in-house or vendor training, broker-dealer conferences such as this one, and some self-studies as well. Okay, so CPE code 188.
Okay, so while you all write that down, we'll move on to a couple other insights. Mike?
Sorry? Yep.
So the next couple of slides focus on concerns we have about the level of experience audit staff have with PCAOB standards. And just to lay the groundwork there are about 3,400 registered broker-dealers. Of those, over 1,000 of them are audited by firms that do not have any public company clients. There's 162 firms that meet that criteria. So that's roughly about half of the total number of registered audit firms that audit broker-dealers. The deficiency rate for firms that don't have any public company clients is higher than it is for firms that do have public company clients. In addition to that, we also note that at the smaller firms, there are a significant number of audits that are performed in fewer than 100 hours. And even further, there's approximately a third of the audits that are performed by those firms, those 160 plus firms that don't have public company clients, are performed in less than 40 hours. So the indicator there is if you're not spending that kind of time working in the PCAOB standards environment, it does raise some concerns as to whether you're getting sufficient practice, you're flexing that muscle enough. You know, the adage is practice makes perfect. And so we are seeing there are some concerns that firms that don't do this as frequently as others have struggled with compliance. So as I mentioned before, we've seen that the firms that don't have public company clients, issuer clients, do have a higher deficiency rate. It's actually fairly significantly higher, 86% for those firms that don't have public clients versus 49% for those that do audit public clients. In addition, those high rates of non-compliance also are reflected in the attestation work, the work on the compliance report and the exemption report. We have a high rate of non-compliance with those at firms that have no public issuer clients. Okay, so this next chart is kind of an interesting detail. So the dark blue is the firms that audit broker-dealers but don't have any public company clients. And you can see there that that 60% of their 60% of the audits that were done in less than 100 hours were done by firms that don't audit public company clients. And the numbers, you can see that in the far left column, the number is skewed towards the firms that don't have public company clients, and then those that do have public company clients have very few audits that they're doing in fewer than 100. In fact, it's virtually none. And then as we get into larger hours, such that audits that take over 5,000 hours, almost all of those are done at bigger firms that have both 100 broker-dealer clients and 100 issuer clients. And then in the middle there, it starts to stratify a little bit more, as you might expect it to do. Now, I think the takeaway here is we're not suggesting that firms that don't do issuer clients shouldn't be doing broker-dealer audits. Not at all. In fact, we've had results where firms that don't have issuer clients have done very well on inspections where we've not identified any deficiencies. But what we are saying is that this really has to be something that gets an appropriate level of attention and training for your staff. And it also requires executive level involvement at the partner, senior manager level, people who we would expect to have more experience, making sure that they're properly supervising and reviewing the work done by less experienced staff. Okay, so we have, I think, our last polling question. So I'm going to read you there's really no facts here, it's more of an opinion item. So in your experience, which of the following best summarizes the effect of an auditor change on audit risk? and you can select more than one here. So audit risk increases because a new auditor won't have a complete understanding of the client in the first year. Sorry.
No, you're good. You're good.
Okay.
Yeah, you can only select one answer, I think.
Oh,
That's my fault, Greg. Sorry.
Okay. Audit risk decreases because a new auditor is more likely to be rigorous in the first year. Audit risk increases because a new auditor is less likely to be skeptical of management. Audit risk decreases because a new auditor is more likely to be skeptical of management. Audit risk increases for another reason, or audit risk decreases for another reason. So if you just take a second and respond to that, and Ryan will report back the results.
We're gonna be good. It's gonna be unanimous agreement, I predict, on this one. Though it's an opinion question, there's obviously a right answer, which makes it an odd opinion question, but.
All right, so A had about 40%.
Mhm.
B through E were all in the low to mid. People really didn't like that.
Did not like F? No votes for F. Okay. A's your winner, Greg.
Fair enough. And again, there was no right answer per se, but I think that was consistent with what we would expect. So the next slide here helps to illustrate how the pace of auditor changes has impacted the marketplace here. So as you can see here, that excuse me, that the majority of audits that we looked at, and this is our observations from audits performed by firms that audit fewer than 100 broker-dealers over the past 3 years, 2020, 2021, and 2022. And you can see the largest number of audits are completed by firms that have had the client from 3 to 10 years. The next largest number is those that have had a client relationship for 10 plus years, followed very closely by those that have had a relationship from 1 to 3 years, and then a smaller number have had between 6 and 12 months, and an even smaller number less than 6 months. There's no maximum or minimum tenure that would indicate audit quality, but it does indicate, what we are seeing here is there is a lot of volatility in the marketplace. We also see a number of firms, there's been consolidation with the industry, and there are firms that are taking on a lot of new clients, particularly clients that have been, that were formerly served by a firm that has been sanctioned and is now either barred from work or has elected to scale back its PCAOB audit practice. And the caveat there is just from a client acceptance perspective to think about what was the relationship that that firm had with the predecessor auditor, and how would that necessarily fit in with your practices, and is this a client that you're prepared to support, and are you willing to make the commitment in terms of time and effort to do the work as well as maintain your existing practice? Because one of the things we're seeing is that, and I think DEI noted this in one of their examples, where a firm grew its practice by 500%, but only grew its partner base by 50%. And so there's a legitimate question there: are there enough resources? And that's just at the partner level, and you have to think about it at the staff level as well. Excuse me. Okay, and this last slide, or not last slide, but this slide here basically documents deficiency rates by fee range, again, over the 3-year period from 2020 to 2022. And you can see that the dark blue is the more recent period. The light blue is from, I think, from 2014 or 2015, when we first started doing broker-dealer audits under PCAOB standards. For those who don't remember, for the first few years of the program, we were still operating under AICPA legacy audit standards. And you can see that generally the deficiency rate has gotten better across all categories. The dark blue line is smaller than the light blue line. The rate tends to be pretty high across the board. And right now we haven't seen a direct correlation to fee to deficiency, but certainly that is something that firms should take into consideration, is whether or not the amount that they're collecting is sufficient to provide an appropriate level of resources to serve the client. Okay, so this is our final CPE code, which is 588. And then I'll just quickly update you on our current status. So the 2023 inspections, obviously we completed those back in December. We looked at 60 firms, 103 audits across those 60 firms. All the field work is completed. The inspections were completed with a mixture of in-person, remote, and hybrid inspections. A hybrid inspection being where part of the team is on site at the firm's office and part of the team is working remotely. And again, as we've mentioned several times, we're in the process now of gathering the information and putting together the report that we expect to issue by sometime in August. The 2024 inspections are very much underway. The numbers that we're looking at are going to be comparable to 2023's numbers. Field work will continue through December. We are looking to do more inspections in person at the firm's locations, although we will continue to do a number of remote inspections and we'll continue to do a number of hybrid inspections. And then the report generally is consistent year to year, but we won't know for sure until the inspections are done when that report, but it'll be sometime in 2025. And with that, I don't know if we pretty much at time.
Yep. Right time.
So thank you for your attention. Appreciate it very much.